Welcome to the Three Corners Capital Monthly Minute, a video sharing what we're paying attention to. The big news is the announcement of broad tariffs on Wednesday, April 2nd, after the market close. The market reaction was swift to the downside as investors repriced the value of company earnings in the face of the magnitude and depth of the proposed tariff increases and effects on overall confidence due to continuing uncertainty. We're recording this video around lunchtime on Monday, so there's a lot that could happen in between now and when you're watching. But coming into this year, we expressed concern with the concentration of large tech stocks in the market and their valuations. We've stayed diversified across asset classes and maintained a focus on quality companies with strong balance sheets and at reasonable prices. So, for example, please look at this chart showing international stocks for one, real estate and bonds, along with the two popular U.S. stock indices, the S&P 500 and the NASDAQ 100. So since the market peaked on February 19th, the S&P 500 is down about 20%, NASDAQ over 24%, whereas international stocks and real estate are down 11 to 12%, and bonds are up 1 to 2% as investors have rushed into safe assets. So at times like these, it can be easy to be fearful and very concerned, but let's take a step back and objectively think about the big picture, positives and negatives. On the good side, consumer and corporate balance sheets are healthy. There's a lot of cash on the sidelines. The economy's been chugging along, although slowing some recently. Interest rates and inflation had been moving lower, and unemployment is still low. On the bad side, the level of uncertainty is pretty high, with concerns that such broad tariffs will cause a spike in inflation. That could make it hard for the Fed to lower rates. Also, tariffs could reduce corporate earnings and cause hesitation on the part of consumers and businesses in their spending and investing. On the other hand, as consumers pull back, who knows, prices may not rise as much as feared.
So what should investors do, if anything? Well, if we know that our experiences can lead us to feel, a lot of emotion that can cause us to be, feel paralyzed. It can make us make decisions that are adverse. But through our decades of experience, we know that it's times like these that require us to be rational and think long term. So consider this chart of the S&P 500 showing extreme one-day declines and then the trailing returns thereafter. You can see that even though there are major declines, there was only one occurrence of the 15 since 1960 where the S&P 500 trailing one-year return was negative. On average, it's actually over 30%. So there are three things that we're going to be doing. One is tax loss harvesting, which is the ability to take a loss for tax purposes, but stay invested so that we can participate in an eventual recovery. The second is rebalancing, where we'll be able to, in essence, sell high and buy low. And the third is adding cash where appropriate. All said, we live in a 24/7 news cycle, and we want to be a trusted source of wisdom for you. If you have any questions, please let us know. We monitor on a daily basis on your behalf for your success. Never hesitate to reach out. Thanks.
Thank you.